it's not uniformly high. And so, can you just talk for a minute or two about what your observations have been about that over the years?
Yeah, I'd say it's a lot nicer to do this now with less hair than it was when I was young, and because it's one of those things where there's four quadrants, right? We talk about, Sean, like the things that the things that you don't know, the things that you don't know that you do know, which is kind of weird. Most people don't, there's not a lot of things that you don't realize that you know, but then there's the ones that you don't know that you don't know, and in my experience, that has been unfortunately a common occurrence when it comes to the taxation and planning for retirement accounts. And that's the most dangerous quadrant of all, for advisors, for clients, et cetera. Because when you think you know something but you don't, like when you don't realize, there is an opportunity for more mistakes to occur there. And indeed, we've seen that over the years, Sean. When we first created the Savvy IRA program years ago, we gave advisors 7 questions, and advisors scored statistically very poorly. I think that's a very kind way of saying it. I mean, as I often say, there were 3 questions on a 7-question quiz, where if I had given my 3-year-old, who will be home here in a couple of minutes from preschool, if I gave him that and asked him to come in here, blindfolded him, gave him a crayon and said, "Hey, buddy, circle an answer," he would have scored statistically higher, which is not very good. And we're talking about trained professionals trying to get an answer right, scoring statistically worse than a chance encounter. And over the years, we've just seen that borne out time and time again, both from subscribers to the program, but particularly people who come to these workshops, right? The number one comment that we get on evaluation form after evaluation form is, "I didn't realize how much there was that I didn't know, or I didn't realize how deep this was, or it's so much more nuanced." And that is what we're really hoping to do in this workshop, right? Is to illuminate, to take an area where oftentimes when we have, we so often in our industry, we get broad knowledge, right? We go an inch deep and a mile wide. And that's great when you're coming into the business and you need to learn as much as possible. But as your business matures, as you want to specialize in an area, as you decide what sort of niche or niche, depending upon who you are, whichever one you want to use, like which, target market you want. If you want to work with retirees, which a lot of advisors do, you really need to begin to hone in on that knowledge and to focus intently on the types of things that those individuals need. And the wonderful thing is, from our perspective as a business, right, from an advisor's perspective, is people have a lot of money tied up in retirement accounts. We're talking about, trillions and trillions of dollars, and IRAs are sort of the collection point for a lot of these things. Not always, but money tends to move from plans to IRAs. We've got the peak of the baby boom wave is just starting to crest now. I mean, we've been talking about 10,000 baby boomers retiring a day here for the last decade or so. But the reality is, at the early onset of this, it wasn't really 10,000, right? It was just the start of the wave, on average 10,000. But we're now getting to like that peak time when more people will be retiring with more money roughly than ever before. I know kind of in a market dip here, but there's bigger dollars. I was looking at a report the other day talking about the trillions of dollars that have been rolled over from plans to IRAs in recent years. And it's just mind-numbing numbers. How big of a slice of that pie do you need to earn as an advisor to have an incredible business and to help a whole bunch of people make sound decisions about their retirement? Not a big piece.
Right. And of course, additionally, the backdrop is that there's been a lot of changes to the rules in the last few years, probably more so than you can correct me, but I'm guessing if you look, whether there any other 3 or 4 year period where there have been this many changes than there have been in the last 3 or 4 years.
It's hard to imagine. And we can even go back even further because, the last 3 or 4 years, obviously, Sean, you're alluding to, the SECURE Act, the original version, right? And then also, of course, this year we had SECURE Act 2.0, and there's been other ancillary things. We had like the CARES Act changes and so forth. But we can also go back a few years earlier to the Tax Cut and Jobs Act even, right? Which is now coming up on about 6-7 years. old. And while it didn't have many direct changes to the retirement account rules, I mean, it eliminated Roth recharacterizations for for conversions. That was sort of a big issue, but it was one thing. Most of the impacts, though, were indirect. It changed all the tax brackets. It changed the capital gains rules. I mean, there was all these indirect effects. So I often say, IRAs are like the octopuses of the planning world. They have tentacles that kind of cross over into all sorts of planning. When we're looking about estate planning, well, we got to look at what it means for your retirement accounts. There's unique estate planning considerations. When we're talking about your investment plan, well, obviously, you're going to do something with your IRA money. We've got to have the right investments. When we're talking about your tax plan, how are we going to distribute those assets in the right way? We're talking about education planning. How are you funding for college for individuals? Is part of your retirement savings going to be earmarked towards that? Are you going to be using penalty exceptions? Is it impacting your FAFSA? Even tax-free Roth IRA distributions have a FAFSA impact if you're taking distributions at an inopportune time. And we can keep going on and on, but the point is, it has reaches across the entire planning sphere. And to your point, the rules are constantly changing. So we've really got, in my opinion, just an optimal situation for advisors to dive in and add value. We've got a lot of people who have a lot of money in something that is complicated and the rules are always changing. I mean, that seems like if I was an advisor, I mean, I am an advisor, but if I was thinking about where I want to focus, that's kind of where I would want to focus, right? Things that have all of those attributes to it, and retirement accounts fit that bill.
Right. And if you're out there and you're a mid-career advisor, and 5 years ago you're feeling like, hey, I think I've been here for a few decades, starting to get a little gray. Feel like I've got clients who've successfully gone from working into retirement. I feel pretty secure about my IRA knowledge, but it's really a whole new ball game now. It seems there's been so many changes. Is that a fair characterization?
I mean, I think so. I mean, when you have a change, the likes of the SECURE Act, which eliminated the stretch for most beneficiaries, and then while perhaps not as impactful for most people, just the recent changes with SECURE Act 2.0, we had nearly 100 changes. SECURE Act 1, the original version, or what I refer to oftentimes like the OG, right? The OG SECURE Act, that had a dozen or so changes that impacted people, and we thought it was a really big, and it was. This recent bill had really close to 100 changes, and the effective dates of when they start, some began as of the day the law was passed, December 29th last year. Some began a few years later on January 1st of this year. Some don't begin to take effect until next year, others 2025, others 2026, some not for 10 years out to 2033. And then others were retroactive, back before the law was actually passed. So it's not just what is changing, but when do these things take effect? And of course, talking about changes that'll happen over the next few years, Sean, one of the things that we have to think about is how will planning change if things just go according to plan, meaning, in 2025, at the end of the year, we're set to sunset so much and so many of the changes that were made by what we were talking about before, the Tax Cut and Jobs Act. And we are really in a low tax rate environment for most people. Even if you look at nothing else but that planned change, overall, about 70 to 80% of taxpayers, depending upon what source you look at, pay lower taxes as a result of the Tax Cut and Jobs Act. Now, that is true across income spectrums, meaning, yes, those at the highest end did benefit tremendously from this bill on average, but so too did taxpayers in the lowest quintile. So it's not just, you could argue, right, as a political argument, which we won't get in here today, but as a political argument, you could argue, hey, too much of this went to the top 1%. But people at every income threshold saw their income taxes on average go lower. You also, many people said people on the coast, they got crushed because of the SALT caps and all that sort of stuff. Well, yes and no. Many of those people who were complaining about the SALT cap weren't really getting the state and local tax benefit anyway, because they were subject to AMT, and AMT eliminated it. So yes, some people are hurt. I'm not gonna, look, as someone who for very many years lived in New York and felt the sting of state taxes, like I get it. But when we're looking at taxpayers, even in high tax states like New York and California, et cetera, on average, even people in those states saw lower tax bills. Maybe not as much as people in other states, but on average, they saw their rates go down. So if that's the case, if on average, again, everybody's situation is unique, some people certainly saw higher, but on average, if 80% of people saw their rates go down because of this, well, if those changes go away, doesn't that mean like 80% of people are scheduled to have higher tax bills going forward? So we're kind of in this, environment here where we've got some very unique opportunities with people for only a handful of more years, potentially. Now, Congress may extend that, but right now, if they do nothing, which is usually the thing to bet on in Washington, right? Yes, they pass laws, but if you have to take the over or under for a law passing, you always take the under. And the under here says that it expires and it goes back by default. Congress has to act to keep it. And you can pretty much guarantee that if Democrats have at least the presidency or the House or the Senate, that's going to be very difficult because, as we know, that particular law was not very popular with Democrats.
Right. Any inside baseball and what people are saying, or is that what they're saying? It says, well, it just depends who's in power.
Yeah, I mean, I think it's still way too early to say, and it's going to depend upon largely what the election looks like in 2024 and how that goes both from a presidential, a House, and a Senate perspective. But again, I have to, if I'm a betting man, if I was a Vegas odds maker, I'm betting on most of those provisions expiring. I could see Congress and everybody getting together to say, hey, here are 2 or 3 things that we like that we can agree on. For instance, the small business deduction for the small business deduction, that 20% pass-through deduction. That is sort of a deduction that's needed to keep parity, if you will, with S corporation and LLC and sole proprietor revenue and profits to the lower 21% corporate tax rate that was made permanent, right? While we're talking about here things sunsetting, that's only for the individual side of the tax code. On the business side, most of those changes were made permanent. Well, if all of a sudden you have a scenario where you go back to much higher personal tax rates, but you keep the low business rate, right? Well, then people are just going to start doing many more C corporations. And Congress doesn't want that because the IRS is already overworked and understaffed. The last thing they need is more tax returns to deal with and not have a chance to go through. Yeah. So it seems likely, again, I would take the under because you need to have Republicans win the House, the Senate, and the presidency to be able to extend this. And I'm not predicting they won't. I'm just saying the odds of all 3 are generally lower than at least one staying with Democratic control.
Right.
Especially when you have an incumbent Democrat president.
Yeah, right. Just to remind anybody that's coming in the middle of this, we're previewing Jeff's April 24th to 27th virtual workshop, IRA Planning Workshop, SECURE Act Strategies for Guiding Clients Now. So Jeff, in session 1, you're going to be talking about RMD rules for 2023 and changes to contribution deadlines. Why, if advisors aren't up to speed on this sort of thing, what sort of impact are they possibly looking at experiencing for themselves and or their clients?
Yeah, I mean, certainly on the RMD path, that's something that clients always have questions about. And man, again, just lots of changes recently. The SECURE Act, once again, the SECURE Act 2.0, I should say. I got to actually figure out which one, I got to start saying and specifying which SECURE Act we're talking about. But SECURE Act 2.0, that changed RMDs once again. And this is sort of a weird year for RMDs in that no one in 2023 has to start taking RMDs because of their age. No one this year. And the reason is, if you were born before 1951, which means you were 72 or older by the end of last year, by the end of 2020, had to start taking your first RMD and you get no relief, right? So SECURE Act 2.0 had absolutely no impact on you if you were born before 1951. If you were born 1951 to 1959, SECURE Act 2.0 passed last year in December, changed your RMD age from age 72 to age 73. So someone who was born on, December 31st at 11:59 p.m., in 1950 had to start taking RMDs last year. Someone who was born 5 minutes later on, January 1st, 1951 won't turn 72 until this year. Well, that means they don't have to start RMDs until they're 73, which is next year. So no one this year starts taking RMDs because of their age. And then, of course, in the future, when those who were born in 1960 or later get to the RMD age, they won't have to start taking RMDs until they reach age 75. So what this does is it actually gives people a little bit more time to potentially plan for things like Roth conversions, et cetera, with lower income, or to make their lower Medicare Part B premiums for another couple of years. And of course, more than anything, it's just when clients ask questions, they want to feel confident that the person they're working with is on top of this stuff, right? Like, clients want to know that if they could go and find this information, that you already have it or have a place to go to get it.
Right. So one of the things you discuss in that session has to do with QCDs.
Mm-hmm.
A fair number of advisors have clients that like to take advantage of the qualified charitable distribution rule, but you're going to be discussing the QCD anti-abuse rule. Why is it so important that people understand the ins and outs of that thing?
Yeah, one of the changes made by the original SECURE Act, once again, kind of prefacing which one we're talking about these days, is that it changed the IRA contribution rules. Prior to the original SECURE Act, if you were 70 and a half or older, you were not able to make a an IRA contribution, a traditional IRA contribution that year. So once that year hit, no more traditional IRA contributions. And it was kind of odd because it was the only sort of account that you couldn't contribute to after 70 and a half. Roth IRAs had no age limit, 401ks, SEP IRAs, nothing had an age limit except traditional IRAs. So as one of the changes, the dozen or so that we talked about made by the original SECURE Act, Congress said no more age cap for traditional IRAs. But Sean, once you reach 70 and a half, you also have the ability to make a QCD, that is to take money from your IRA and move it directly to charity. And one of the things that we should emphasize and pause here for a moment to point out is that age 70 and a half continues to be the age for QCDs, even though the age for IRA RMDs has now risen to 72 for some, 73 now for others, 75 for others down the road. For everyone, the QCD age is still 70 and a half. So Congress got worried. They said, what if someone wants to give money to charity who's over 70 and a half, but they're not entitled to take a deduction, maybe because their itemized deductions don't exceed their standard deduction? What if instead of making the gift directly to charity, what if they were to contribute to their IRA first, get the deduction as an above the line deduction, and then, yes, give the money to charity, right? They were worried that people would take the IRA deduction as an above the line deduction that you don't have to itemize for, and then effectively use it as a charitable contribution by making a QCD. And they were so worried about that they put in this anti-abuse rule, which effectively, and in much more complicated language, says, to the extent that you make post 70 and a half deductible IRA contributions, you can't make QCDs, or we're going to deny your QCDs, which is kind of lousy. It really, for anyone who wants to give to charity via QCD, which, by the way, Sean, should be just about everyone who wants to give to charity who's 70 and a half or older, can't really think of a better way to do that. It really diminishes the value and almost makes it not worth it at all to make deductible traditional IRA contributions. It's kind of sad. And the reason I say it's sad is because it is a ridiculously complex piece of legislation. And all it's really doing is stopping people or preventing people who, yes, they might have been making, contributions to their IRAs, but they were ultimately giving the money to charity. Was this such a big deal that we have to add all this complexity to seniors' lives? They've got enough to worry about. All right, I'm going to get off my soapbox now, Sean.
Yeah, well, that's how I feel about the entire retirement system, frankly. It's like, you work your whole life, and then we've just set the table for this, huge landmine field for people to maneuver through in their golden years.
Yeah, I mean, I'm thinking about like between Social Security and the taxation of retirement accounts and everything, like it's supposed to get easier when you get older. What happened?
I don't know. I don't know. Someone's got to figure it out. So you're going to be talking about rollover options, and this is a thing. Advisors have corporate have clients who are in corporate America, and they've been sucking it away into their 401ks or their 403bs or their state employees, whatever. The rollover thing is a big kind of touchy issue. So what is it from your perspective that you're going to cover that's so important? Why do people really need to get sharp on this issue?
Yeah, I think there's two primary reasons here. One is a business development reason, right? And obviously that's important. Actually, let me say three, right? One is a business development reason. We can cover that in a second. The second is just making sure you're doing right by your client. And the third, which is sort of related to the second, is we are in a heightened regulatory environment for these sorts of things. And so you can do both yourself and your firm and your compliance departments and everyone a great service by doing a better job analyzing and documenting reasons for and against rollovers. And there's lots of things that should go in. Like we often focus on things like fees and investment options, but there's all sorts of other considerations from things like estate planning to creditor protection differences, which are more complicated than people think in many ways. Things like different sort of there may be different withholding options, different distribution options. I mean, all of those things come into play. And sometimes you may be entitled to special tax breaks like NUA or things like that need to be properly evaluated. So I think it's important. We just should always be doing what's right for people. I don't care what your, whether you're subject to a suitability standard or whether technically you're fiduciary. Like that is the legal aspect, right? To me, if you're not trying to do the right thing by people, we have a fundamental difference in life and we're just not going to get along very well, right? But if we're trying to do the right thing for people, that's the first thing. So if we want to do the right thing, we've got to have, the desire to do that, but B, we have to have the knowledge to do that. So how do we know what's right? Well, we got to dive deep into each of these areas. Then beyond that, right, it becomes, if we're doing the right thing, how do we make sure we're showing that to a regulator when they come in? Because whether you're an RIA or whether you're a broker or whatever it is, you're subject to more scrutiny today than you have been at any point in the past. And that continues to be an area of high interest for regulators. And, it only takes one scenario to hurt a career that has otherwise been, relatively stellar. As advisors in this business, our reputation is everything. And so if you have an issue with your reputation, it can really damage your business, not to mention all the emotional and turmoil and all that sort of stuff. So really understanding, documenting, et cetera. And then, of course, if you're able to do this in an effective way and really show people that you're evaluating this at a deeper level than most of the other, they walk into some other advisor's office, they say, "Hi, roll over your account. Nice to meet you. What's your name?" Right? If you're comparing to that, which unfortunately today is still too much of our industry. We're getting better, but still too much. Well, if that's the case, then you're going to stand out. People are going to look at you as the professional you are, and you are going to attract more business than you would otherwise. And that's what we're about, right? Is finding ways to have bigger business, to have bigger impact, and do the right thing.
And of course, when it comes to doing education marketing, acting as a financial educator, or if you're trying to build your business, you're going out into the community. Anybody who will be at Jeff's workshop, you become a member as part of the workshop fee, you become a member of the Savvy IRA Planning. One of the presentations, one of the FINRA reviewed presentations Jeff has prepared for you is called 6 Retirement Account Options Every Retiree Must Know. So that's something else you'll be able to add to your toolkit in terms of building new business and educating people in the community. So Jeff, we're coming up on the end here. We'll just talk a little bit about session 3, contributions and deductions, avoiding contribution mistakes. Well, obviously everybody wants to avoid that, but is there anything else you want to say about that before we kind of wrap it up for today?
I think at the very least, we need to understand what can and what can't go into a retirement account. And also when we're looking at switching retirement accounts, what money can be rolled over where if you put too much in, either from a rollover or just contributing too much, it is subject to significant penalties. Now, it can be fixed, but it's got to be fixed in the right way. These are the sorts of things, again, that, probably less of an issue on the contribution and deductions for most people if they're advising retirees, simply because, they've passed that point. They've already made those moves. But for younger clients and so forth, figuring out how much can go into what plan, or a lot of times we get questions like, hey, I'm working, can I also make an IRA contribution or a Roth contribution? Or, hey, I've got my regular day job, but I'm also moonlighting. I have a gig work that I do, or I've got a side hustle. Can I put money into the 401k plan at my regular employer, but also have a plan for me? Like, those are the sorts of things that we still get lots of questions on an ongoing basis. And of course, Sean, going forward, there's going to be new catch-up contribution rules for plans as part of SECURE Act 2.0. So that complicates things even further. Whereas, up to now, it's kind of like, well, yeah, I get it. You get reach a certain age and then you put more in. Well, now with plans beginning, not this year, but like in a few years, we're going to have a scenario where you take you have one set of contribution limits from the time you're 0 to 49, another from the time you're 50 to 59, another from 60 to 63, and then another set from 64 until you die. Like, we're making everything, like I said, the SECURE Act 2.0 had nearly 100 provisions in them, but the one thing it did, it had just about everything but the kitchen sink in the bill, except for anything that would make our lives simpler. It just, yeah. Hey, but you know what, Sean? I selfishly, as a human being and a good citizen, I want simplicity. As an advisor and a technical, person, complexity is our trade. It's why we have jobs. It exists, our jobs as advisors in all sorts of fashions, whether you're a tax advisor, a financial advisor, law, we exist because these things are complicated and people need someone to explain it to them. And, just one last thought, Sean, lots of attention lately about things like AI and Chat GPT and things like that. There are lots of things that AI will be able to do. One of the things that it is still, at least today, not capable of is asking people the right questions, and that is like Chat GPT and all its other AI, they're still garbage in, garbage out. If you don't ask the right questions, you don't get the right answers. And that asking the right question, knowing which questions to ask, is where, at a basic level, that is something I would hope that people can walk away from this program with, is knowing which questions to ask to really get to the heart of the matter and do good, solid planning with clients.
Yeah, and I just have to say, it is a huge business opportunity now because the retirement rules have been dramatically changed, and we got huge numbers of people getting ready to go into retirement. People are very anxious about it. The markets are choppy now too. So this coming year, the next few years, really big opportunity for advisors to up their game on this topic and get out in the community, meet new people. There's all these people who are looking for the retirement advisor and putting on presentations or just being able to deliver great service to your clients. Great opportunity to grow your business. So this is the first of several live streams we'll be doing between now and April 24th, when the virtual IRA workshop kicks off. Jeff, thanks for being on here. Everybody, thanks for listening, and we will see you next time. Thanks so much.